Silver, as far as I'm concerned, it's up 43% this year. And when you have a Fed that is going to come in and lower rates into an environment where asset prices are at or near all-time highs in the stock market, in gold, when silver's on this run, I would expect to see this rocket fuel charged. When the market was from 2007 to 2011, when they cut rates, gold went up 118%. From 2020 to 21, when they cut rates, gold went up 35%. So I think not only will you see that in silver, you will see it certainly in gold. But going back to silver for a moment, 52 million ounces of silver were already delivered on COMEX this month, with 3 weeks left to go to push it even higher, just over 2 weeks. There's no question that something bigger is happening. I mean, there is no question about that, right? And a lot of it focuses on the LBMA. I'm going to try and make this part a little bit easier to understand. It's somewhat complicated for people who don't understand the lingo. I'll try to make it as easy as possible. First of all, when you look at gold, speculators are returning into the gold market. We can see that on COMEX with open interest rising again. That means open interest is the amount of interest, and people are interested in buying the metal. Open interest is rising, and prices are breaking out of this consolidation range. We see it bust out again. That's the normal link between purchasing and higher prices, right? But in silver, what we're seeing is something different. The rally is being driven not by speculators, but what seems to me by some form of a short squeeze, because you have record high lease rates in London to lease the gold. That would be the same thing if you wanted to short a stock. There's a cost to borrow the stock from an entity that then allows you to short it. A stock is something, if you short something or naked short something you don't have, you have to borrow the stock first and then short it. Same thing here. You have record high lease rates with silver in London, anywhere between 5 and 6.5%. Normally, those lease rates are somewhere around 1% or a fraction of a percent. Even in times of stress, they barely get above 1%. Right now, they're between 5.5% and 6%. I'll talk more about that in a minute.
The London Bullion Market Association, LBMA, faces a dangerous imbalance. Roughly 600 million ounces of silver trade daily, but only about 140 million ounces are truly available for delivery. At the same time, there are an estimated 1 to 2 billion ounces of paper claims outstanding. In short, the paper market dwarfs the physical supply. If even a fraction of investors demanded delivery, London could face a default. Meanwhile, U.S. banks, fortified by bringing metal back to domestic vaults, appear better positioned. This divergence highlights a shifting power balance in global bullion markets, with Europe's financial giants under growing strain.
But you also have falling open interest, meaning the demand by the speculators is falling with heavy delivery demand. So far, 58 million ounces have been delivered since late August. Almost 11,000 tons have been delivered year to date. This points to shrinking physical liquidity and mounting pressure on the market. In other words, the short positions are struggling to get the metal to cover their positions. As the lease rates go higher, the people who own it are like, nah, we're not going to give it away 5 or 6%, which is way higher than it ever is. With everyone standing for delivery, this is a problem. And when we talk about what's happening on the LBMA, recent data shows about 600 million ounces of silver are traded every day in London. There's about between 1 and 2 billion ounces of paper claims on meaning they could stand for delivery, between 1 and 2 billion ounces, yet the official available free float is only 140 million ounces. So in other words, if there's 1 to 2 billion ounces of claims against 140 million ounces available to be delivered, and a lot of that is already locked up and not truly liquid, what could possibly go wrong? In other words, London has virtually no free silver to meet these rising investor demands or to back the billions of ounces in outstanding contracts. This is getting interesting. And at the same time, you see the COMEX flush with metal. All of that metal, I remember I screaming, this is not about tariffs. And all of that metal that's come back to the United States has put I believe the U.S. banks on solid footing. Normally when the U.S. bank shorts COMEX, they go long delivery contract in London to offset.
Silver isn't just another commodity, it behaves like a Giffen good. In most markets, higher prices reduce demand. But with silver, rising prices often fuel even greater buying. Investors, industries, and governments rush to secure supply before it becomes scarcer. Tesla, solar manufacturers, and now even the U.S. government, after officially classifying silver as a strategic mineral, are stockpiling. Add in investor enthusiasm, and you have a feedback loop where shortages intensify. This dynamic magnifies risks for short sellers and bullion banks, making silver's upward trajectory potentially far more explosive than traditional supply-demand economics would predict.
Well, they've brought all that metal back, and you could argue to put their book in order. These European banks are facing an existential threat. With lease rates and prices spiking, the risk of a delivery default in London is rising. And, this is the chain reaction that you would talk about. Silver, its status as a Giffen good. I don't know if you know what a Giffen good is. Then again, a Giffen good is something that as prices rise, demand increases. Most assets or investables are the opposite of that. As the price spikes, demand falls. With this, as price rises, demand increases, making shortages even worse. As the industrials will say, man, the price is rising, we got to buy more, we got to get it, we got to secure it. The hedge funds and the traders say the price is rising, let's jump on, let's get them on board on this. And its status as a Giffen good makes the potential shortfall even worse. Now, when we talk about silver, as far as I'm concerned, it's up 43% this year. And when you have a Fed that is going to come in and lower rates into an environment where asset prices are at or near all-time highs in the stock market, in gold, when silver's on this run, I would expect to see this rocket fuel charged. When the market was from 2007 to 2011, when they cut rates, gold went up 118%. From 2020 to 21, when they cut rates, gold went up 35%. So I think not only will you see that in silver, you will see it certainly in gold. But going back to silver for a moment, 52 million ounces of silver were already delivered on COMEX this month, with 3 weeks left to go to push it even higher, just over 2 weeks.
From a technical perspective, silver is on the edge of a historic breakout. Chart analysts point to a 45-year cup and handle formation, one of the most powerful continuation patterns in market history. Silver's ceiling around $50, tested in 1980 and again in 2011, marks the rim. A breakout beyond this level could unleash decades of pent-up energy. By classic charting rules, that implies silver's first target could reach $90 to $100 an ounce. When you combine this setup with today's supply shortages and record lease rates, silver's price action starts looking less like speculation and more like inevitability.
And as I mentioned, those lease rates at as high as 6.4%, they never get above 1 to 2%. And if only briefly when they do in times of stress, this is signaling that the bullion banks are trapped by their own over-leveraged promissory notes, the European bullion banks in particular. I think that's something that needs to be focused on. At the same time, you have silver added to the strategic minerals list by the U.S. government. This means that big buyers are entering the market, including the U.S. government. Companies like Tesla and others will stockpile silver at the same time. And so London's deliverable silver supply is vanishing. Its industrial needs and its investor demands are colliding between the industrials like Tesla and the investors. This is Giffen's good at work. I don't know, I'm looking for a severe shortage. Not to mention, You have a 45-year cup and handle pattern on silver, which is one of the most powerful technical setups you can find in markets, period. And on such a long time frame, it carries huge implications. It portrays 45 years of suppressed energy ready to be released, kind of like a coiled spring. And I think that the structural and monetary pressure, once unleashed, the move is violent. The way that it typically works is that a cup and handle is a continuation pattern. The cup is the long base, in silver's case, from the early 1980s through the decades of the consolidation. The handle is the pullback, the tightening range, like 2011.
While silver dominates supply discussions, gold has quietly outperformed even the hottest sectors of the stock market. Over the past 6 months, gold's return has quadrupled the S&P 500's despite the AI boom capturing all media attention. Since 2023, gold has doubled in value while equities trail behind. Yet mainstream coverage remains muted. Insiders, however, are acting. Institutional investors are exiting stocks at a 7-to-1 ratio while standing for massive gold deliveries on COMEX. The disconnect between public perception and institutional behavior suggests that gold is already being treated as a safe haven by those with the most to lose.
So once prices break above the rim, that $50 price that we saw in 1980 and 2011, the price can go parabolic. The classic charting rules, the upside target, you take the depth of the cup added to the breakout point. So the depth of the cup, the rim is at 50, the bottom is just below $4 in the 1990s. That's about a $46 or $47 spread between the top and the bottom. So in theory, the breakout above 50 with no resistance above it, add $46, $47, the difference from the top to the bottom of the cup, you're at a $100 initial target, between $90 and $100. And when you throw in the shortage, when you throw in the demand by the big money, when you throw in the demand by the BRICS countries, etc., I don't know, triple-digit silver isn't really so out of control. It's not out of line as far as I'm concerned. One last point I'd like to make about gold and silver. You know, it's interesting to me that, and in particular gold, because silver has yet to catch the same fire that silver has, that gold has caught. And, you know, we look back over the last half a year or so, and the S&P 500 in the last 5 months or so is up almost 1,700 points. That's one of the strongest rallies in history, right? Gold is up about almost 40%, about 39%, when compared to the S&P's return over the last 5 months, which is one of the strongest returns ever. Gold is up since 2023. Gold's up 100%, the S&P is 67%, that's great. But just over the last 6 months, where everyone's focusing on NVIDIA and stuff, where it's up as big as it is, 1,650 points, gold's run is up 4 times the S&P's return, just in the last 6 months. It's up 37% versus 9%.
Today, small investors are more leveraged into equities than ever before. Record stock exposure, record margin debt, and record options trading. Meanwhile, insiders are quietly moving into gold and silver. This is a classic late-cycle signal, public enthusiasm at historic highs while smart money exits. Precious metals, often overlooked in mainstream finance, are absorbing unprecedented institutional demand. With geopolitical tensions, monetary easing on the horizon, and supply strains in London's bullion system, the stage is set for dramatic moves. If silver breaks its $50 ceiling, triple-digit prices may not be fantasy, but a realistic outcome of structural stress.
And so, even amongst this AI boom, the biggest tech story since the internet, equities are still trailing gold, and yet nobody talks about it. So I remember when gold finally broke through $400, I couldn't believe it. It finally broke through $400 all those years ago. And if you would have told me that we are sitting at futures almost at $3,700 right now, and the media and no one understands it, to me, it's absolutely insanity. The big money understands it. And this is what I was talking about recently, where you have the largest exposure to stocks in the history of the stock market by mom-pa investor. You have the largest ever margin exposure, which is $1 trillion, and you have the largest exposure to options. So you have the public all in on stocks, all in on margin, and all in on speculation with options. At the same time, the investor, the big money, the insiders are leaving at a 7-to-1 clip, leaving the equity market and going where? I don't know. Maybe they're going to gold, as the biggest money in the United States is standing for billions and billions and billions and billions and billions, and I can keep on going every single month. Every single month we are seeing huge deliveries into COMEX, and why does nobody talk about it? So let's just paint the backdrop for a minute and talk about our wonderful mainstream media that lacks all journalistic integrity, period. The greatest boom ever in the S&P because of the AI revolution is trailing the price of gold and silver. The insiders are dumping equities and running to, we don't know, as the public is all in the stock market. Not just all in, greater than at any time in history. In fact, not only are they in greater than any time in history, the valuation is at the highest point in history, greater than the 1929 crash, greater than the '08 crash, greater than the dot-com crash. And they're not just all in, they're all in on leverage and margin. And so with all of this metal coming into COMEX, both gold and silver, record amounts, net importers, record amounts, and the public not owning any, and it outperforming the S&P, where the hell is Fox News? Where the hell is this idiot Jim Cramer? Where the hell are all the people that are supposedly looking out for you and I?